NIO delivered nearly 48,000 vehicles, 47,979 to be exact, in just the first 2 months of 2026, which is massive. To put that in perspective, that volume approaches what some traditional automakers sell in an entire quarter for a single model. January alone saw a 96.1% year-over-year increase. It is a huge jump that demonstrates demand is not just recovering but accelerating. In my opinion, this tells me that consumer confidence in the brand is at an all-time high, and the production side is finally operating with complete efficiency. But if I connect this to the bigger picture, the absolute most bullish signal hidden in this data isn't actually that massive delivery volume. In my analysis, it's their product mix, specifically which cars they are selling right now. That is what makes this so significant. Wait, so am I saying it's not just about selling more cars, but selling their most expensive ones? Absolutely. Looking at the numbers for their premium third-generation SUV, the ES8, it is staggering. In my opinion, this flagship model completely dominated their sales mix. It made up roughly 60% of all deliveries across January and February. This kind of concentration at the high end is rare in the automotive industry, and it tells me that NIO's brand perception has shifted firmly into the luxury tier. In January alone, it was almost two-thirds of all their sales. To understand why that matters so much, I have to look at the underlying economics. The ES8 commands an estimated average selling price of $75,000. When you combine that premium price tag with an estimated 20% gross margin, meaning for every dollar they make on the car, they are keeping 20 cents after production costs. The ES8 generated about $433.6 million in gross profit over those 2 months alone. Let me repeat that figure because it is so critical. Nearly $500 million in gross profit from a single model in just 2 months. That single high-end vehicle is essentially covering roughly 80% of NIO's total operating expenses, creating a massive safety net that insulates the company from any volatility in their lower price segments. My analysis suggests this is the kind of financial foundation that allows a company to invest aggressively in future growth without fear. But they aren't just selling to the luxury market anymore. NIO has been expanding its footprint with secondary brands to capture a much broader audience. In my view, this is where their strategy shows real sophistication. They have the Onvo brand pulling in that mid-tier market between roughly $30,000 and $45,000. And then there is the Firefly, which is grabbing budget-conscious buyers for under $20,000. This is the brilliant part of their strategy. Those accessible models are doing exactly what they were designed to do without tanking the company's finances because of the margins. Together, Onvo and Firefly accounted for over 19,000 deliveries. Even at those lower price points, they added another $91.5 million in gross profit, maintaining a very healthy 16% margin. In my opinion, achieving 16% margin on vehicles priced under $45,000 is exceptional and speaks to their manufacturing efficiency and supply chain mastery. So they are using the massive profits from their luxury flagship to bankroll their expansion into budget markets. They are expanding their total addressable market without sacrificing the bottom line. This is the exact opposite of what most automakers do, which is to launch low-margin volume vehicles first and then struggle to move up market. NIO flipped the script. They established premium credibility first, and now they are leveraging that brand halo to capture entry-level customers who will eventually upgrade to higher-end models as their incomes grow. In my analysis, this is a customer lifetime value strategy straight out of the tech playbook. Here is where it gets really interesting, though. Generating all that profit is great, but let's look at the final tally. Because of those strong margins from both the premium and accessible lines, my analysis shows the total estimated gross profit for January and February hit $525.1 million. However, their estimated operating expenses for that same period were $540 million. So they are technically still in the hole. The gap to operational break-even is now a mere $7.5 million per month. So why am I calling this such a massive success if they are still losing money? Because in my view, a gap that small is essentially noise. It is within the margin of error for any forecast. It means that any positive variance in volume, pricing, or cost control flips them into profitability instantly. That is the perfect question. What is fascinating here is how they are primed to close that final gap. You have to factor in NIO's hidden ecosystem of other income, specifically the services. In February, they crossed a staggering 100 million cumulative battery swaps. That is not just a vanity metric. Each swap represents customer engagement and infrastructure utilization. Combine that with their battery-as-a-service subscriptions coming from over 1 million vehicles currently on the road. In my opinion, it is like a smartphone subscription model. Traditional automakers are just selling you the iPhone, but NIO is selling you the iPhone and charging you a monthly iCloud subscription. That recurring revenue changes the whole game. They have built high-margin, recurring service revenue streams that traditional automakers simply lack. My analysis suggests these streams carry margins north of 30 to 40% in many cases, which is significantly higher than vehicle manufacturing margins. Plus, they have interest income from cash reserves and potential sales of regulatory EV credits to provide even more padding to the bottom line. When you layer all of these together, my view is that the $7.5 million monthly gap disappears entirely, and likely has already disappeared in March. So what does this all mean for the listener? It means sustained profitability is transitioning from a long-term dream to a near-term reality. Short sellers, the investors betting against the stock, rely on that gap of operating losses to defend their bearish thesis, and that gap is practically gone now. In my analysis, every month of scale reduces it further. We are at an inflection point where even minor improvements in volume, product mix, or this ecosystem income will result in sustained operational success. The upcoming Q1 earnings release could mark the exact moment NIO officially crosses that threshold. I am watching for that date closely because I believe it will be a historic moment for the company and for the EV industry as a whole. Okay, let's move on. Technicals bull case. NIO opens the session at 4.765 after closing at 4.720, with the previous high at 4.790 and low at 4.640, establishing a tight consolidation range. For a green day confirmation, price must reclaim and hold above 4.76 with strength and sustained volume. If buyers push through 4.76, momentum can build toward 4.80, which acts as the first intraday resistance. A clean breakout above 4.80 increases the probability of an upside extension toward 4.82 and then 4.87, which aligns with the 200 EMA and represents a major resistance barrier. Holding above 4.71 keeps short-term structure stable, while 4.68 remains the critical floor that bulls must defend to avoid momentum loss. Technically, price is consolidating between 4.64 and 4.79, forming a compression range that can fuel a breakout. Although the stock is trading below the 200 EMA at 4.87, the shorter-term averages are flattening, and MACD remains slightly positive, suggesting recovery potential if buyers step in with conviction. A successful push above 4.80 could trigger short covering and expand the move toward 4.87. The broader structure remains range-bound, but a green session would signal strength building above key support and could shift short-term sentiment from neutral to cautiously bullish. Bear case. If NIO fails to hold 4.70 early in the session, downside pressure may accelerate quickly. A breakdown below 4.70 shifts control to sellers and opens the path toward 4.64, the recent session low and immediate support. If 4.64 fails to hold, the next downside objective becomes 4.58, which represents a deeper support zone and acts as the critical floor for the current range. Rejection near 4.75 or inability to reclaim 4.76 would confirm weakness and increase the probability of continued selling pressure. The stock remains below the 200 EMA at 4.87, maintaining a broader bearish bias, and the Ichimoku cloud overhead continues to act as dynamic resistance. MACD is flattening, indicating that bullish momentum is fading, and declining volume during consolidation suggests vulnerability if sellers return with higher participation. The trading structure remains a sideways range between 4.64 and 4.79, but a decisive break below 4.64 would signal continuation of the broader downtrend and potentially expose the 4.50 region next. In a red day scenario, sustained trading below 4.70 confirms weakness, rejection at lower highs reinforces bearish structure, and loss of 4.58 would significantly damage near-term support, shifting momentum firmly in favor of sellers.